or a strategy and planning department in companies. We also have corporate finance teams in large corporations. Some corporations have both, some have either one. The ones that have both work together to decide which are the big capital investment decisions that they want to take. And there is a process. There are 4 steps that we're going to talk about. Number 1 is the idea generation. Usually you can have even outside consultants that can come and help you identify what are the projects that might add value to the company in the long term. You can have your in-house strategic planning teams. Once the idea is identified, whether it is to maintain business or expand and grow business, the corporate finance team needs to jump in and analyze the investment. Now, this is where we're going to learn about some very interesting tools like NPV and IRR, and that's coming up shortly. That how do we conduct the analysis of this investment? Then, step number 3, looking at multiple projects and what is their overall impact on the enterprise. So, this is at an enterprise level where an individual project might be profitable in isolation, but then you have to consider it along with the other projects and see maybe you might need to schedule or prioritize some projects. Let's say, coming back to the theme park example, let's say you're planning on making a theme park and you're also planning on making a hotel. So it might be a good idea to first make the theme park and see what type of footfall you're getting, and then you might want to then make a hotel, because naturally if the theme park is successful, then it will make the hotel have a lot more chances of being successful, and that is where your scheduling and prioritization might become very, very important. And then, of course, is your post investment review. Were you being too optimistic? Were you being too conservative? It helps put things in perspective, and it really helps with the budgeting as well. That what did the original estimate have a basis of saying that we might have this much sales, and the reality of the sales or the cost was different. And it's very, very interesting to actually do this work in real life. So what are the main tools? Well, another very main tool which is not written here, which is used very commonly by senior management, is something called a payback period. Because I've done this work actually practically, and when I used to report for these projects, not only did I show NPV and IRR, but I also used to show something called payback period, that how many years are you going to get your original investment back in, because that is something that senior management is usually very, very interested in. Anyways, let's focus on the material at hand, which is NPV and IRR. Now, what is net present value, or NPV? First of all, there is going to be an initial cash outlay. This is your initial investment that you're doing, and usually this is negative. This is your cash flow at time 0. You're going to be paying this money, you're going to be investing this money, you're going to be burning the dollar to earn the dollar, right? And which means, of course, you're going to have your future cash flows coming in after that, and that will hopefully be positive, right? So these will be positive, let's say cash flow 1, positive cash flow 2 in the second year, and so on and so forth. Now, what we want to see is that are these future cash flows greater? Are they greater than your investment that you're doing right now? Because if they're not, obviously it makes no sense to do this investment. And not only do we want the future cash flows to be greater, but we want the present value of these future cash flows to be greater. Why? Because of course we need to account for time value of money as well, right? So we're going to take the present value, we're going to discount these future cash flows, and after discounting, the present value of these future cash flows should be greater than the initial cash outlay that we are doing, and that means that you are going to have a positive NPV. And if you have a positive NPV, if this number is positive, then that means this is a good project. Now, where does the IRR come into this picture? So think about this discount rate that we are using, this R. And from your quants reading, of course, you must remember that R is the interest rate, also called the required rate, also called the opportunity cost, also called the discount rate. So we've seen many faces of this rate. Here we're using it as a discount rate, which means we are discounting these future cash flows by this rate. Now, the higher this discount rate will be, the lower this whole present value is going to be. And if we keep increasing this discount rate to a level where your present value of the future cash flows becomes equal to the initial cash outflow, then your NPV will be 0. Let me repeat that again. Let's say you have a positive NPV, right? And you're using a discount rate of 10%. Now we say no, we don't want to use a discount rate of 10%. We increase it to, let's say, 15%. And the present value of these future cash flows goes down. It goes down to an extent, because obviously it is being discounted at a higher rate, it goes down to an extent where it is equal, the present value of these future cash flows is equal to your initial investment, which means CF0 minus the present value of these future cash flows is not going to be positive anymore, it is going to be 0. And that discount rate, which makes the NPV is equal to 0, is what is your IRR. And why is the IRR also very important is because it signifies that what is the discount rate at which your project's NPV will be 0. That means it's not going to be worth doing. And why that is very, very important is easy to understand with something called an NPV profile. And let's say your discount rate is on this axis and your NPV in dollar terms, of course, NPV is always in dollars or amounts, is on this axis, and discount rate will be in percentage. So let's say as your discount rate is going up from 5% to 10% to 15%, what is happening to your NPV is that it is coming down and eventually it is becoming 0 when the discount rate is 15%. And why this is very, very important is because when you are in the strategic planning department or the corporate finance team, you have certain expectations of interest rate, right? And if there is a possibility of interest rate going to 15%, that means your project is not going to be profitable anymore. So when you are analyzing your NPV, it's not a fixed number. NPV depends on what discount rate you are using. And as the discount rate goes up, the present value of your future cash flows comes down. This initial cash flow is not impacted because this is already being done today. So it is not related to the interest rate. So as the present value of your future cash flows comes down, your NPV or your net present value goes down up until a point where it reaches a discount rate which makes it equal to 0, and that is your internal rate of return. And whenever you're making an investment, not only should you know what is the NPV, but you should also know what is the IRR, because if the discount rate goes above that IRR, you are going to be in negative NPV territory, which is obviously something not good, because then your project is actually taking value away from the business instead of adding value to the business. So this is the formula for NPV. You have your initial cash outlay. Usually, of course, this is going to be a negative number the sign of negative is not there, but when you will be given the data, of course, usually this is going to be a negative number. And these future cash flows are going to be positive. They need to be discounted back to today, depending on which year they are there. And that is what gives you the net present value. And if it is positive, you should accept. If it is negative, you should definitely not accept that project. If we are talking about independent projects which have nothing to do with each other, so let's say you are talking about making a theme park, and at the same time you're talking about going into something completely unrelated and independent, let's say space travel, right? So if both of them have positive NPV, go for both of them. Now, if this is a mutually exclusive project, right, let's say you can go for a theme park. On the same piece of land, you can make a hotel. So, right, you have to choose between one. So definitely you will go with the one which is offering you the higher NPV. So here is an example for you. And what I would request you to do is please pause the video and try to calculate the NPV of project A and the NPV of project B and decide which one you want to do. Alright, hopefully you were able to get the answer that project A is the one which is giving you the higher NPV, and you might have followed this entire process which is shown over here, that you had your initial cash outflow of -1,000 and then all these positive future cash flows discounted back to today at the 10% cost of capital, which is giving you 78.82. However, there is an easier way of doing this, and that is through your calculator. So what you can do is press the CF function. Don't forget to clear the memory. So press second and press clear work. So that will clear the memory. CF0 is by default showing as 0, but we want it to be -1,000. So first we'll enter 1000, which is 1000, and press the plus minus sign to make it negative, and press enter so it sets it equal to -1,000. Then press the down arrow and enter 500 and press enter, so it will set the first cash flow as 500, and since this 500 is only occurring once, so the frequency will be set to 1. So press the down arrow and set the frequency, leave it at 1. It is already preset to 1, so just leave it at 1 and press the down arrow again. Enter 400 and press enter, which will set the second cash flow to 400. Press the down arrow twice, leaving the frequency as 1. Then enter 300 as the third cash flow, and then similarly 100 as the fourth cash flow, and then press the down arrow again to enter the frequency of the fourth cash flow as 1 as well, because it's only occurring once. Then press the NPV button next to the CF button in the same line as the CF button. It will ask you the interest rate. The minute you press the NPV button, it is going to ask you, oh, you've told me the cash flows. The calculator will say, tell me the discount rate I should use. So you will tell it 10, and this is not going to be 0.1, this is going to be 10. The calculator knows this is 10%. So just enter 10 and press enter, and then press the down arrow again, and it will be showing NPV as 0, but you have to press the compute button on the top left, and then it will show you the computed NPV, which is 78.82. You can also do this on Microsoft Excel. So what you have to do is go to any of the Microsoft Excel row and column, and you can press is equal to sign and write NPV, and then open the brackets, enter the rate, let's say it is 10%, and enter the values in whichever cells is your data which is for your cash flow. So let's say -1,000, and plus 500, plus 100, whatever is the data, and you just select that data and that will go in the values, and you can then close the bracket and press enter, and it will calculate the NPV for you. Now this is assuming that the data is already for different years. If you want to have customized dates set, then instead of NPV you have to use XNPV, and the first two things will be the same, which is the rate and the values, but here there is going to be an additional variable that you can provide, which is the dates of each of these cash flows. Okay, next, of course, IRR, and IRR is that discount rate which makes your NPV is equal to 0. And it's very important to know is because this is the rate which you're earning. This is what you're earning from this project. And your discount rate should be lower than this, your cost of capital. So let's say this is the company, right? And of course, the CFA Institute refers to this as the issuer because it is issuing these stocks and these bonds to get equity and debt financing, and then it's investing in these assets, or rather I should say capital investments. And what's important is what are we earning, what is the rate of return that we are earning, the internal rate of return from this capital investment, and it should be greater. So let's say we are earning 15%, it should be greater than whatever is our weighted average cost of capital, right? Of depending on what is the weight of our financing of debt, what is the weight of our financing from equity. So the weighted average cost of capital should be less than what we are earning from our investments. Otherwise, we're not very good at what we're doing. So what is the decision rule over here? Naturally, the IRR should be greater than the required rate of return. And required rate of return is usually your cost of capital, right? What it's costing you to get that money, what you have to pay to the debt providers, what you have to pay to the equity providers, and we have to take a weighted average for this because maybe 50% of our capital is coming from debt, 50% is coming from equity. So we calculate a weighted average, and we'll look at this calculation later. But for now, just have a high level understanding that there is a certain cost of the money that you're getting, and there is a certain return, the rate of return, the internal rate of return of these projects that you are earning. And if it is greater, the rate of return you're earning is greater than the cost of your capital, then you should accept the project. And obviously, if it is less, then you should reject. This required rate of return or the cost of capital is also known as the hurdle rate, and this is a reference to those hurdles which you have to jump when you're running a hurdle race, right? So similarly, for the project to be able to survive, it needs to have an IRR which is higher than this hurdle of, let's say, 10%. Only then it will be accepted. And this is for independent projects, like for example when we were talking about theme park versus space travel, right? You can do both if they are both having higher IRR. But if you have, let's say, theme park versus hotel, and they're both going to be made on the same piece of land and you have to choose only one, right, then definitely you should go with the one which is giving you the higher IRR. So how do we go about doing this calculation? And I'm directly just going to go and show you the solution because I don't want to bother you with this very tedious method of solving for this R through trial and error. And obviously you're not required to do that in the exam as either, because you have your calculator and you can calculate your IRR through the calculator. Now, the first steps are the same. you enter your cash flow function, clear your work, enter all the cash flows like we have done previously. The only difference is instead of pressing NPV, you're going to press IRR. And you're going to press compute and it is going to tell you the IRR of these cash flows. How convenient. And that will tell you the discount rate at which the NPV will be 0. You can also do this in Microsoft Excel by going to any cell, pressing equal to IRR, opening the bracket and putting in the values. Guess is an optional feature where you can try to guess 10%, but even if you don't use this, it's okay. You can just calculate the IRR without the guess as well. Now, here is where things get a little bit confusing, because let's say you've got the theme park where the NPV is, let's say, a positive $1 million, and you've got your hotel where the NPV is a positive $2 million, but your IRR is higher. Let's say it's 15% for the theme park, whereas your IRR is only 10% for the hotel. Now, which project shall we do? Assuming we can only do one. Because earlier, of course, we said that first we'll make the theme park and then we'll make the hotel. And in that situation, of course, we need to have more land. But let's say currently we only have enough land to do one. And which one should we do first? Should we go with the theme park that is having an NPV of 1 million, or shall we go for the hotel which is having an NPV of 2 million? Usually what we do is we always go with the one which is having the higher NPV. The reason for that is because NPV is a dollar term, it's a dollar value. And with NPV we know how much dollar value is getting added to our business. So in this case, since the NPV is higher with the hotel, we'll go for the hotel first. And this is easy to do if you're having independent projects, right? Single independent projects, and there is no confusion for multiple projects. But if there are multiple projects, then it gets confusing, especially if the project size and cash flows are not conventional. So what does that mean? First of all, I want to talk about this point over here, which is conventional cash flows. Now, conventional cash flows means the first cash outflow is negative and the rest are positive. This is the normal convention that we see in these type of projects, that initially there is a negative outflow and then positive cash flows. However, if let's say in the middle there is a negative cash outflow as well, then what happens is that your IRR can go mad. This is what we call the 2 IRR problem, and this is something you cannot deal with easily, because then you don't know which IRR is actually correct. And the reason why that happens is, and in terms of your NPV profile, it is like your NPV becomes negative twice, right? So there are two discount rates at which your NPV is actually 0. It's just very, very confusing to actually deal with this type of a situation. So if you're dealing with unconventional cash flows, it becomes a big problem. Secondly, if you are dealing with projects which are mutually exclusive, that let's say you have one piece of land and you can only do one, then again it becomes confusing, because your NPV might say one thing and your IRR might say the other thing. So if you choose the one with the higher NPV, that could be a wrong decision, because you're not really thinking about it in terms of the size of the project, because this initial cash flow might be only, let's say, 10 million for the theme park, and the initial cash flow might be, let's say, 25 million for the hotel. So if you compare your NPV of 1 million, here the 1 million NPV is a much larger percentage of the 10 million investment, whereas the 2 million NPV over here in the example of the hotel is a relatively smaller percentage compared to the investment of 25. So NPV actually doesn't take into account the size of the project. It's just showing you that the hotel is giving a higher NPV, but it is not comparing that to what is the initial amount of investment, and it's not looking at it in terms of the percentage return. And that is where a third measure is going to come in, which is return on investment capital, but we will just look at that shortly. First, let's talk about the conflict between NPV and IRR a little bit more. So let's say you're considering two projects. One initial outlay is only 1 million and another where the initial outlay is 1 billion. So there is a 1000 difference here, right? 3 zeros difference over here. And obviously it might be that the smaller project has a higher IRR. Maybe this is giving you 15%, whereas the large project might be having a lower IRR, but of course it's a much bigger value. And if the IRR of this project is 10% and your cost of capital is less than 10%, then it will have a positive NPV. And because the size is so big, let's say your cost of capital is 9%. And this 1 billion project is giving you 10% return, whereas this 1 million project is giving you 15% return, which is obviously much more than 9%. But still, if you will calculate the NPV of the 1 billion one, it's probably going to be much more than the 1 million one, because even though the IRR is only slightly more than the cost of capital, but the size of the project is much, much, much bigger. So the NPV will be much bigger. But it's not really a apple to apple comparison, so that is a problem with NPV. However, we have to always go with NPV. Even though we know that it is not taking into account the size of the project, we still will always go with NPV because it is a direct measure of the increase in value which will be there for our firm. However, practically speaking, what you should obviously do is also take a look at the NPV profile. At what rate does the NPV become zero? And you should talk to your economist regarding the interest rate expectation, because if interest rate is going to go up, that means let's say the IRR of this big project is 10% and your cost of capital is expected to go up to 11, then you shouldn't do this project because very soon your NPV could become negative, right? You should use NPV and IRR in combination, but of course, if you have to go with one, NPV always wins. The reason for that is, number one, it is of course NPV is a direct measure of your value being added to the firm. And number two, there is something very wrong with IRR. IRR assumes reinvestment of cash flows. Now, what does that mean? So let's say you have your CF0 and then you have your CF1, CF2, CF3, and you calculate your IRR and it comes to a certain rate which makes the NPV is equal to 0, and let's say that is 10%. So you say that the internal rate of return, or let's say that is 15%. So you say that the internal rate of return on this project is 15%. Now, what is the assumption over here is that you're going to make 15% throughout the life of this project, which is 3 years. But this cash flow you're getting after 1 year, you have to invest it at 15% because you're assuming that you're earning 15% throughout the life, right? So even the second cash flow, you have to be able to invest it for 1 year and this one for 2 years at 15%. But will you be able to, right? I mean, is it easy to find investments that give 15% for 2 years or 1 year or for exactly the number of years that you want? It's not a practical assumption, right? And that is the problem with IRR, because it assumes that you will be able to reinvest those interim cash flows. So I'd rather use a word over here called interim, that you're getting during the life of the project at the IRR rate. And this is not practical, it is less realistic. And secondly, as discussed already, that when you have non-conventional cash flows where you have first negative and then positive and then again negative, right, which is non-conventional, then you could have something called a multiple IRR problem, and that is going to be a nightmare. So because of these three reasons, we don't go with IRR, we go with NPV. However, you should also look at IRR, because we want to make sure that the interest rate is not going to go above that, otherwise this project will be in a loss. So what are the advantages and disadvantages of NPV and IRR? Of course, NPV advantages, it is a direct measure of the value being added to the firm, and theoretically this is the best method. Advantages of IRR, that it is showing you the return in percentage terms, right? That is also very good. And it allows us to compare it with our cost of capital or the required rate. So we know how much space we have in terms of what we are earning and what we have to pay. The disadvantages, however, of IRR is that it assumes that cash flows, interim cash flows, are going to be reinvested at that IRR rate, and this could also conflict with NPV analysis, and of course there is the problem of the multiple IRRs. And the disadvantage of your NPV is that it does not consider project size, and this is something we have talked about already. So what is the solution? Return on invested capital, or ROIC. Here, not only are we taking, okay, what are we earning on this, but we are also taking, okay, what are we investing on this. Now this 1 million is not your NPV, right? This is your after tax profit. Let's say it's not 1 million, it's 0.5 million. Now where is this number coming from? This is your tax, your profit after paying your tax, right? So whatever profit your business is earning after paying the tax, but interest is not deducted over here. Why we don't deduct interest is because when we talk about the denominator, this is average invested capital, which includes, so let me actually take you to the next slide. So this includes your equity as well as long-term liabilities. Now what does that mean? When you start a business, of course you have your assets and you have your liabilities and you have your equity, right? So you start off with your common shares, maybe you will take a bank loan, right? Then you might have some accounts payable, accounts receivable, cash, inventory, fixed assets, right? Property, plant and equipment. Now when we're talking about your invested capital, your long-term loan and your equity, since we are taking our long-term loan, therefore we are going to not take into account the interest payment that we are doing in the numerator over here. That is part of the return on the invested capital. So here we are taking the profit which will go to the providers of equity, and we are also taking the interest which will go to the provider of debt. So this numerator actually is going to be the profit without deducting the interest. However, tax will be deducted because that has to be paid to the government. So this is very important. Note that the numerator excludes interest expense because that represents a source of return to the providers of debt capital, and the denominator, and this is because the denominator includes not only equity but also long-term loans or debt, right? And this gives us an idea about what is the return that this business is generating. And it's very, very important. So let me just go back to the first slide on this topic and emphasize on why this is important for an analyst, is because usually we don't have inside data of a company. If you're working for an investment company and looking at different companies to invest in, usually we don't have the inside information or the information necessary to calculate a project's NPV or IRR. We're just having access to the financial statements of a company, and what we can do is just take their profitability, adjust it for interest, that the profit plus the interest minus the tax, of course, divided by the debt, long-term debt and equity, and that gives us an idea about what is the company's ability, the management's ability to convert the capital that we are providing them into profits. And naturally, if you are having an expectation of a cost of capital of 10%, and if the ROIC is 9%, then this is not good, right? However, if it is 15%, then it's higher than the cost of capital, which is good, because that means this is good for the firm's value. And of course, if the ROIC is greater than the cost of capital, then your NPV will also be positive. So here is a question for you from the curriculum, example 8. They've told you what is the numerator. Denominator you have to calculate yourself, right? I'll just give you some clues. First of all, you can just ignore the asset side. We'll be taking the long-term loan and the equity part, which is these two. But you can't just directly plug in the figures, because whenever we're dealing with balance sheet items, if we are taking the income for the whole year, right, this is going to be for, let's say, year 2. So that means this data is end of year 1 and this data is end of year 2. But we need data for the whole of year 2, because in the numerator you've got the whole of year 2 starting from Jan to ending in December. So similarly, for your new denominator also you need for the whole year. So how do you think you should go about doing that? So please try and solve this, and then I will show you the solution. Okay, so hopefully you figured it out. With all balance sheet data, what we have to do is actually we have to take their average, right? So you'll take these three, which is your long-term debt, your share capital, including your retained earning and your share capital, that's your equity, and you will add it to the next year's and then divide it by 2, and you will divide it by 2, and that will give you the average invested capital. And you will put your profit in the numerator, your average invested capital in the denominator, and you will get the return on invested capital, which is 8.73%. All right, so that is it for this concept, and we will pick up the next concept in the next video, which are the principles for this capital allocation process. What principles do we need to stand by, and what are the common pitfalls we need to be aware of?